everyone. Season's greetings to all of you from SBI Mutual Fund family. 2022 put global economy and financial market to multiple tests. We saw geopolitical turmoil, heightened tensions between large economies, inflation worries putting an end to cheap money, and all of it driving consolidation in financial assets. 2023 takes on to the backdrop laid out in 2022. Indian economy enters the year with multiple macro challenges. These challenges will iron out through the year, but whether it happens as early as 2 quarters ahead or by fag end of the year is difficult to time. Europe and the US are headed for a recession in 2023, while China is on road to bumpy recovery. Decoupling seldom works. Weak external demand and tighter global financial conditions will likely drive India's FY24 growth down to near 5% versus a likely 7% in FY23. That said, much of the growth challenges are global. Once these headwinds fade, India can post a strong rebound. Private sector and banks' balance sheet are strong to support growth in the coming decade, and the world order is changing. Manufacturing finally comes to India. Hence, even as corporate capex could take a mild breather in 2023, we are positive beyond that. Consumption is likely to stand as a relatively resilient factor amidst global headwinds. 2023 may throw interesting opportunities in mass consumption segment. Government tax has recovered sharply, aided by improved gross tax collection and income tax collection. Yet, fiscal deficit may not be able to consolidate materially in a pre-election year. Infrastructure support from government may likely continue. We do not know whether weak state capex since COVID is a bellwether to deeper problems underneath or something else. 2023 may unfold. Any global shocks aside, we expect a material softening in India's inflation. WPI will likely be muted. Assuming flat energy prices and reduced aggression in price hikes of household goods and services, CPI inflation should soften to near 5% as early as first quarter FY24. Food inflation outlook is still uncertain though. Softer inflation implies a sharper moderation in nominal GDP growth to high single digit in FY24 versus a near 16% in FY23. After a long period of inactivity, bank credit growth has accelerated in recent months. Even as we expect nominal growth to moderate in FY24, substitution away from external credit, more so in first half of 2023, will likely keep domestic credit demand afloat. RBI policy action in FY24 will depend not only on domestic growth inflation dynamics but also on the relative hostility of global financial conditions. To the extent that CPI drifts toward 5% handle, the MPC is likely to turn its focus to addressing the growth slowdown in the latter part of next year. In contrast, if global financial conditions remain as hostile as they were through this year, then the space for easing will foreclose, with the continuing focus on how the CAD will be funded. Cost attractiveness for dollar borrowings have sharply reduced, putting the capital inflow from external commercial borrowings at risk. Hence, external account concern remains, and we'll have to watch out the crude price dynamics and FII sentiments towards Indian assets for 2023. FX reserves below $500 billion can test India's reserve adequacy. Just as we highlighted earlier, currency performance could also be the year of two halves. Market assumptions on Fed trajectory could get tested over the next few months. As such, US Treasuries could rise before it glides softer. Consequently, dollar could also strengthen before it embarks on a correction path. This, coupled with near-term capital flow risks in India, could keep depreciation risks alive on the very immediate basis. However, if we see 6 to 12 months ahead, a repeat of 2022 is less likely. Rupee could be range-bound around current levels. Indian equity markets saw high volatility, though key indices ended in marginal green through 2022. Weakening global growth weigh on earnings outlook, and high bond yields continue to put pressure on equity valuations. In 2023, while inflationary pressures should continue moderating, growth slowdown may intensify. This should keep earnings outlook muted. Valuations are already expensive, limiting the upside. 2023 may therefore continue to be the year of volatility for equities, at least in the first half. We are positive on fixed income assets, even as we recognize few risks that still entail in terms of eventual global monetary policy trajectory, tightening domestic liquidity, rising of bank credit to deposit ratio, and unfavorable outlook for foreign capital inflow. These are some source of risk. Yet, our positivity stems from maturing domestic monetary tightening cycle, benign outlook on India's inflation trajectory, and valuation attractiveness relative to other asset class. These are our broad outlooks for next year. Tell us what is your choice of asset class for 2023. Signing off for this month. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.